Hello, small business management students, and welcome to Chapter 11 of the course, Forecasting Financial Requirements. This is a relatively short chapter, so it won't take too long to review. I do want to make sure I go over some important points, and the quiz will be very short on this particular chapter. So as we move through this course as a virtual course because of the situation with the coronavirus, I want you to understand that everything is very fluid. In other words, things can change, and some quizzes may be very short, some quizzes may be longer than others. The videos that I tape will be the same way. But I want you to know that my ultimate goal is to make sure that you receive all the information you need to complete this course successfully and to get as much out of this course as you would have if we would have been continuing our face-to-face meetings. So forecasting financial requirements is a very important part of starting your own business. And it's one that a lot of people overlook or do not talk about in depth. So here are the learning goals for this chapter. And let's talk about why it's necessary to do financial forecasting. First of all, and I've talked about this before, but when we mention pro forma, or when you hear the word pro forma, that means estimated. You're estimating cash flow, you're estimating sales, you're estimating, and so because new businesses don't have any history to go by. Now, an existing business that is seeking investment perhaps to expand, then that would be different. But a brand new business from scratch uses pro forma financial statements. Okay, and the purpose of using these statements or developing these statements is to try to determine how profitable the business is expected to be and at what sales level. And when I talk to you about when I first started my own business and I did the income statement in reverse, that was basically a pro forma statement. I was putting together an income statement to see if that business would be able to provide the level of sales necessary to deliver the net income that I needed to succeed or to survive. Okay. It also helped me determine how much and what type of financing I was going to need. Now, this is a point that a lot of people don't really realize until they start opening the business. So I opened the business with a line of credit, and I'll talk about that later this semester. But I opened up the business with a line of credit that I had, a personal line of credit that I had from our home. My home was paid for at the time, and I had an equity line of credit that was pretty substantial. And I borrowed from that equity line of credit to finance my business. But a lot of times people don't have that opportunity. And then that would actually help them, well, that would make them or force them into the decision of how am I going to finance this? Am I going to finance it through debt by taking on loans or borrowing money from the bank, or am I going to take on equity financing? And equity financing, not meaning them themselves, but through possibly partners who will buy some equity into the business. And so we'll talk about debt and equity as we go along, but mine was personal owner's equity. I financed the business 100% through my own financing and through my own equity line of credit, and therefore the equity was 100% owner equity. It also, by developing these statements, especially a pro forma cash flow statement, it'll help us predict whether or not we have enough adequate cash to survive. And there's a slide here in a few minutes that we'll go over this a little bit more in detail. So when we're looking at profitability, we're looking at the income statement. We know where that net income comes from. It's after we have taken sales and subtracted out cost of goods sold to give us that gross profit, then subtracted the operating expenses, the interest expenses, and taxes to come up with that net income. We talked about this in chapter 10, but it's very important to understand that these elements are very important. We also talked about which elements the owner has a little bit of control over. This here is just a pro forma income statement from a company that's listed. It's in your textbook. You can take a look depending on what edition of the text you have. But this is the 18th edition example for a fictitious company called DNR Products. For your business plan, you should have 3 pro forma income statements. You can go month 1, 2, and 3. You could go quarter 1, 2, and 3. You could go annual year 1, 2, and 3. But I'd like to see 3 pro forma income statements in your business plan. And so I'm not going to require a balance sheet, and I'm not going to require a cash flow statement. I just want an income statement. And if you need examples, there's plenty of examples in the chapter that show these income statements, and we went over them in detail. So you should have a pretty good idea of what an income statement does and what the equation is. When we're looking at forecasting not only financing requirements but asset requirements, we're looking at working capital, net working capital, and I want to familiarize you with a term called bootstrapping. But first, working capital are all your current assets. It's anything that you can transition into cash in a very short period of time. So it's your current assets, including cash, your accounts receivable, and your inventory. So when you're thinking of that and you're looking at those numbers for working capital, you have to figure out, I had no idea that, and like I said, a lot of small businesses don't look at this closely, and I will admit that I did not as either. But I was surprised to find out that it took about $100,000 to get my store up and running. That's with inventory, equipment, everything that was out there. So it's important that we take a look and try to predict that or estimate it as close as possible. Net working capital is your current assets less your current liabilities. So as you start gaining assets, whether it be inventory or cash or whatever it is, you're also going to be accumulating liability, bills that you owe, accounts payable, and credit cards or maybe loans payments and so forth. Bootstrapping simply is something that small businesses do, that anything that you can do that requires very small amounts of capital. So you're minimizing your investment in sales, you're minimizing your investment in promotions or advertising. And I like to use the example of bootstrapping of a pizza joint going out and putting menus on all the cars at a WVU football game. It's a very cheap way, it's a very minimal investment to promote your business. And so bootstrapping comes in all different forms, but that's just one example that I usually give. But as we're forecasting, a lot of times we have to think, okay, how can I do this? How can I accomplish this but at the same time minimize my investment in accomplishing it? This is where earlier we talked about cash flow for a second, and I said we'd be talking about it later in the chapter. Here's where a lot of companies get into trouble. As your business grows, you need cash. You need cash to increase inventory. You need cash to pay additional employees. And as this graphic shows, you have an increase in sales, which is great, results in an increase in asset requirements. What do you mean by that? Well, if we sell inventory, we've got to replace it. If we want to grow the business, we probably have to replace that inventory at a higher level than we sold it. So we need more cash. This results in an increase in financing requirements. which means we need more money. Um, a lot of businesses, this is where they fail because they will put most of their money just in getting the business up and running. And then once they get that business up and running, they find out they have very little cash to spend, very little cash to pay employees, very little cash to buy additional equipment, very little cash to buy additional inventory. And they nearly, a lot of business will go out of business, quite frankly. A lot of businesses will fail at this point because they're strapped for cash. GoPro, you all have heard of the company that makes the action cameras. GoPro actually almost went out of business a few years ago because they were starving for cash. They had grown, their sales were pretty good, but not keeping pace with how quick they were growing, and therefore they were maxed out on loans and credit. They nearly went out of business. I read an article in the Wall Street Journal where their owner was talking about as successful as they were, they nearly went out of business because they were running out of money. There's lots of ways to determine how much money is good to have and how much financing is good to have. One way is an assets to sales ratio and also a percentage of sales technique. Basically, what I want you to do is you develop your business plan. And I think it's important to put this in your plan is estimate how much money you're going to need to start this business up. That's probably the very first thing or one of the most critical things that you need to do as you start this business. How much money do I need to open the doors? And a lot of times people will look at that and they go, "Oh my gosh, I don't think I can even start this business. I need more money there's no way that I can get this amount of money." But as you begin to estimate how much money you need, then that's where you can start looking at, okay, what level of revenue do I need to have in order to, remember, on the income statement, you start with the revenue and you end up with that net income at the bottom. That's going to help you predict whether or not you can continue in business. Now, as you do this business plan, do not feel bad and you do not get any points deducted if you find out, I'm not making enough money. This business is not worth opening. But don't make that conclusion until you've done your performance statements and you take a look at the net income over the first 3 months or first 3 quarters or first 3 years, whatever it is that you decide, however it is you decide to predict. Obviously, the more assets a firm needs, the greater the firm's financial requirements. And it's also important to remember that if we're going to finance the growth of the business, we need to make sure that we maintain the proper liquidity. In other words, we need to make sure we can pay our bills. Liquidity is the cash on hand that you can, or the assets on hand that you can quickly convert to cash. And so remember that borrowing money is financing. Getting people to invest in your business and you're giving up ownership, that's equity. Equity ownership comes with the investments of owners and retained earnings. So you have to make sure that if you're willing to give up equity, that you'll have enough money to keep the business going, and sometimes that will make your decision on whether or not you finance or you use debt or equity. We talked about liquidity and current ratio, and this is not accounting, so I'm not going to hold you too much to these definitions, but I do want you to know why liquidity is important. You have to have money to pay your bills. Here is another pro forma statement from DNR. Here's a balance sheet, and I'm not requiring you to produce a balance sheet for your business plan, but I do want you to know the equation. If you remember, assets equal liabilities plus owner's equity. And you can see the examples here. And a cash flow statement. You can take a look and see how a cash flow statement works. But it's basically showing how the cash is coming in, where it's going, how you're paying your bills. Um, and it really helps an owner to understand, especially if they find themselves starving for cash. A cash flow statement comes in very handy to see, where's this money going? Why do we not have enough money on hand to pay our bills? Is accounts receivable holding up? Is days in accounts receivable too much? Are people not paying us quickly enough? Maybe we need to offer an incentive, maybe a discount to pay us more uh, in a more quicker fashion. So one of the things you want to do is you want to make sure that your projections are realistic. And and that's the only thing that I ask you when as you're creating your business plan, just make sure that your numbers are realistic. Don't make sure your revenue numbers are real. In other words, you're not going to make $1 million the first month of operation. Okay. So make sure that as number two says, you're making your projections based on the assumptions of how you're marketing the business or how you're pricing your products. Okay. And don't use unrealistic profit margins. Most people are going to have maybe a 50% or less margin um, on their products and sales, maybe much lower. It says don't limit your projections to an income statement, but I'm only requiring you to provide the income statements for me. Um, Nothing here that you have to worry about, and some key terms. And that's the end of this chapter. Again, it was fairly brief, but I hope that you got some sound advice from what I talked about within the video. And what I want to do is there'll be a very, very brief quiz on this chapter, but nothing that you can't handle, and it'll be in the course content section. And again, this is only the second chapter. Today's Tuesday, March 19th, or I'm sorry, Thursday, March 19th. And just getting started on this, please let me know if there's any questions, any comments, or something more that you would like to see. I know that you're all being um, covered up basically with all these online classes, so I'm trying to make mine as easy to navigate, easy to complete as possible, but I still want you to get the information that you need. Okay? Have a great day, stay healthy, and I will talk to you next week on new videos. Take care.